Markets often feel strange right after New Year. This confusion is not accidental. Many people expect clear direction immediately, but January rarely starts that way. The first days of the year are about adjustment, not acceleration. Capital does not rush back into markets. It pauses first. That pause creates uncertainty. Uncertainty feels uncomfortable. Prices move, but without commitment. Moves feel incomplete. One day optimism appears, the next day hesitation returns. This back and forth confuses traders, especially new ones. But this behavior follows a pattern, a very old pattern. Institutions treat January differently. They do not chase early moves. They observe how markets react after resets. Resets change behavior. New allocations need confirmation. Confirmation takes time. That delay creates mixed signals. Mixed signals confuse retail traders. Retail expects momentum. Institutions expect testing. Testing reveals who is emotional and who is patient. Patience is rewarded later, not immediately. Another reason confusion rises is expectation overload. Everyone wants the year to start strong. Strong starts are rare. Stable starts are common. Markets need to absorb new information. Earnings, policy expectations, positioning. Absorption looks slow, but it is necessary. The dollar, stocks, and commodities often disagree early. That disagreement is normal. Different assets respond at different speeds. There is no single switch. When assets disagree, noise increases. Noise feels like chaos, but chaos is often just adjustment. Adjustment precedes clarity. Many traders misread this phase. They assume something is wrong. Nothing is wrong. Markets are recalibrating. January exposes impatience quickly. It tests discipline. Those who rush feel stressed. Those who wait feel calm. Calm does not mean inactive. It means selective. Selective observation improves decisions. Decisions improve outcomes. Early January is not about big wins. It is about positioning. Positioning happens quietly, without excitement. Excitement comes later, after structure forms. This is why confusion appears first, before direction. At MarketPulseUSA by AB, we focus on understanding this phase clearly. So you don't panic during uncertainty, and you don't chase noise, because confusion is not danger, it is transition. And transitions require patience, more than prediction. Mixed signals are common at the start of January. They confuse because expectations are high. Everyone wants clarity after the holiday break. Markets rarely provide it immediately. Different participants return at different speeds. Some are active early, some return slowly. This creates imbalance. When participation is uneven, signals conflict. Conflict feels like uncertainty. Stocks may rise one day, then pause the next. The dollar may strengthen quietly. While commodities hesitate, these moves seem disconnected. But they are part of adjustment. Institutions do not commit fully during this phase. They test responses first. Testing creates hesitation. Hesitation creates mixed signals. Retail traders often misinterpret this. They expect confirmation too soon. Confirmation cannot exist without participation. Participation takes time. Early January lacks full volume. Volume returns gradually. Low volume exaggerates movement. Exaggeration misleads. One headline feels powerful. The next cancels it out. This back and forth frustrates traders. Frustration leads to mistakes. Markets are not broken. They are incomplete. Incomplete information produces unclear behavior. Clarity needs alignment. Alignment comes when capital agrees. Agreement takes time. Another reason signals feel mixed is positioning reset. Old positions are closed. New positions are evaluated. Evaluation slows movement. Evaluation looks like indecision, but it is discipline. Institutions compare scenarios. They don't assume outcomes. Assumptions fail early. Evidence matters more. Evidence appears gradually, not instantly. This delay confuses short-term thinkers. Long-term thinkers remain calm. Calm allows better observation. Observation improves timing. Another factor is emotional contrast. Last year's memory still influences behavior. People carry expectations forward. Markets reset them. That reset feels uncomfortable, but it is healthy. January often exposes weak assumptions. Exposure creates volatility. Volatility is not always directional. Sometimes it is cleansing. Cleansing removes excess emotion. Emotion distorts decisions. When emotion fades, structure emerges. Structure supports trends. This is why early January feels messy before it feels clear. At MarketPulseUSA by AB, we explain these phases step by step, so you don't feel lost and you don't overreact, because mixed signals are not warnings. They are preparation. Preparation always comes before direction, never after. January is not a month for bold predictions. It is a month for careful observation. Many traders want answers immediately. Markets prefer to reveal them slowly. This mismatch creates frustration. Frustration leads to rushed decisions. Rushed decisions usually come from emotion. Emotion weakens discipline. Early January is designed to test patience, not intelligence. Those who wait gain information. Those who rush lose flexibility. Flexibility matters when signals are incomplete. Incomplete signals dominate this phase. Institutions understand this well. They reduce pressure on themselves. Reducing pressure allows clarity. Clarity improves timing. Retail traders often do the opposite. They increase activity. More activity feels productive, but it often increases risk. January punishes unnecessary activity. It rewards restraint. Another reason patience matters is false momentum. Early moves often lack follow-through. Prices move, but conviction is missing. Missing conviction leads to reversals. Reversals confuse impatient traders. Confusion creates doubt. Doubt weakens confidence. Weak confidence causes exits. Exiting too early feels safe, but it sacrifices positioning. Positioning is built quietly, and not during excitement. Patience allows positioning to develop without pressure. Another factor is emotional carryover. Last year's wins or losses still influence behavior. That influence distorts judgment. Distortion fades with time. Time resets perspective. Perspective improves decisions. January gives markets time to breathe. Breathing stabilizes behavior. Stability is more valuable than speed. Speed increases mistakes. Another reason patience matters is information flow. Data arrives gradually. Economic signals need comparison. Comparison needs time. One data point misleads. Multiple data points guide. January provides those points slowly. Slow delivery requires patience. Impatient traders react to single inputs. Professionals wait for patterns. Patterns reveal intent. Intent matters more than headlines. Headlines exaggerate urgency. Urgency pressures action. Action under pressure rarely succeeds. Calm action does. Patience also protects mental capital. Mental capital affects consistency. Consistency builds confidence. Confidence improves execution. January is not about proving skill. It is about protecting discipline. Those who protect discipline early perform better later. This is why patience is strategic, not passive. At MarketPulseUSA by AB, we focus on helping you slow down, not to miss opportunities, but to avoid bad ones. Because the market will always move, but not every move deserves action. Understanding when to wait is as important as knowing when to act. Smart money does not fear confusion. It uses it. When markets feel unclear, professionals slow down. Slowing down allows observation. Observation reveals behavior. Behavior matters more than opinions. Opinions change quickly. Institutions watch how markets react to uncertainty. Reaction shows confidence. If markets fall easily, confidence is weak. If markets hold levels calmly, confidence is forming. This phase is about testing strength, not chasing direction. Smart money reduces emotional exposure. Emotion clouds judgment. They avoid forcing trades. Forced trades increase regret. Instead, they study positioning. Positioning shows intent. They watch where money pauses. Pauses are informative. They observe which assets remain stable. Stability attracts capital. Assets that panic early lose trust. Trust is slow to rebuild. Another behavior is selective engagement. Not everything deserves attention. Institutions choose what to ignore. Ignoring noise is a skill. Noise is loud in January. Silence is valuable. Smart money also manages risk tightly. Risk control comes first. They expect false moves. False moves are common. Expectations reduce surprise. Surprise creates mistakes. They also compare cross-market signals. No market moves alone. Dollar, stocks, and commodities interact. Interaction reveals alignment. When alignment is missing, they wait. Waiting is intentional, not passive. Another key behavior is patience with confirmation. Confirmation must survive time. Time filters weak signals. Strong signals remain. Smart money also avoids emotional narratives. Stories distract from data. They focus on what markets do, not what people say. This focus keeps them grounded. Grounded decisions last longer. Institutions also scale slowly. They don't commit all at once. Small exposure tests. Conditions. Testing protects capital. If conditions improve, exposure increases. If not, losses remain small. This approach reduces stress. Stress impairs judgment. Retail traders often misunderstand this calmness. They think nothing is happening. But preparation is happening, quietly. January rewards preparation, not excitement. Those who prepare early act confidently later. At MarketPulseUSA by AB, we focus on explaining these behaviors clearly, so you understand what patience looks like and why it matters. Because confusion is not an enemy, it is information. Those who read it correctly gain an advantage. Retail traders often feel lost during early January, not because markets are unfair, but because expectations are unrealistic. They want immediate direction. When direction does not appear, doubt creeps in. Doubt leads to overthinking. Overthinking leads to mistakes. Retail traders also react faster than necessary. Speed feels like control, but speed without clarity increases risk. Risk grows silently. Another issue is information overload. Too many opinions flood attention. Opinions feel helpful, but they conflict. Conflicting opinions create confusion. Confusion weakens confidence. Weak confidence leads to frequent exits. Frequent exits damage positioning. Retail traders also focus too much on price. Price alone lacks context. Context comes from reaction. Reaction reveals strength. Ignoring reaction causes misjudgment. Misjudgment leads to poor timing. Another struggle is impatience. Waiting feels uncomfortable. Discomfort pushes action. Action without signal fails. Retail also compares performance constantly. Comparison creates pressure. Pressure encourages chasing. Chasing increases losses. Another common mistake is emotional anchoring. Recent prices influence decisions. Markets move forward. Anchors pull traders backward. This creates hesitation. Hesitation breaks flow. Retail traders also underestimate time. They expect January to deliver quickly. January delivers slowly by design. Another issue is narrative dependency. Stories simplify complexity, but simplification hides risk. Hidden risk surprises later. Retail traders also fear missing out. Fear clouds judgment. Judgment under fear is unreliable. Unreliable decisions hurt capital. Another challenge is lack of structure awareness. Structure develops quietly. Quiet development feels boring. Boredom leads to disengagement. Disengagement leads to poor reentry. Poor reentry increases regret. Retail traders often confuse activity with progress. Busy does not mean effective. Effective trading requires restraint. Restraint feels passive, but restraint is strategic. It protects clarity. January exposes emotional weaknesses, not technical ones. Those who struggle emotionally suffer most. Those who adapt survive. Adaptation requires awareness. Awareness requires patience. This is why many traders underperform early, not due to lack of knowledge, but due to lack of discipline. Discipline is learned through experience. At MarketPulseUSA by AB, we focus on helping you avoid these traps. So confusion does not turn into frustration, and frustration does not turn into losses. Understanding this phase improves resilience. Resilience improves outcomes. The market does not punish traders randomly. It tests behavior. Those who pass the test benefit later. Confusion does not last forever. It fades as behavior stabilizes. Markets begin to repeat reactions. Repetition builds familiarity. Familiar behavior creates confidence. Confidence reduces hesitation. Early January confusion starts narrowing. Signals become less scattered. Moves feel smaller but more consistent. Consistency matters more than size. Prices stop reacting emotionally to every headline. Reactions become measured. Measured reactions show balance. Balance signals maturity. Another sign of clarity is reduced volatility. Spikes become less frequent. Less volatility lowers stress. Lower stress improves decision-making. Participation also becomes more even. More players return. When participation increases, signals gain reliability. Institutions begin extending observation windows. They look beyond daily noise. This broader view improves context. Context reveals direction. Assets start respecting key levels. Levels hold more often. Holding levels builds trust. Trust invites engagement. Another change is improved correlation. Assets begin moving with logic. Logic replaces randomness. Randomness fuels confusion. Clarity also appears in volume behavior. Volume supports moves more evenly. Supported moves last longer. Longevity matters. January clarity does not arrive suddenly. It arrives gradually. Gradual change protects discipline. Discipline prevents overreaction. Retail traders often miss this transition. They expect obvious signals. But clarity is subtle. It whispers before it speaks. Those who stay attentive notice it. Those who rush ignore it. Institutions respond carefully to clarity. They do not overcommit. They increase exposure slowly. Slow increases reduce regret. This phase rewards preparation, not prediction. Prepared traders feel less anxious. Less anxiety improves execution. Another sign of clarity is narrative calm. Commentary becomes less extreme. Extreme opinions fade. Balanced views emerge. This shift reflects alignment. Alignment supports trends. Markets begin spending time at levels. Time absorbs uncertainty. Absorbed uncertainty allows movement. Movement becomes meaningful. This is when January transitions from confusion to structure. Structure does not guarantee profit, but it improves odds. Short-term excitement does not. At MarketPulseUSA by AB, we focus on spotting these shifts early, so you don't confuse calm with stagnation, or subtle change with nothing happening, because clarity rarely announces itself. It develops quietly. Those who recognize it position confidently. Those who ignore it chase later. The first weeks of January quietly shape expectations, not through big moves, but through behavior. Behavior always comes first. Markets reveal what they tolerate and what they reject. This tolerance defines boundaries. Boundaries guide future movement. When markets stop overreacting, it signals internal adjustment. Adjustment builds confidence. Confidence stabilizes participation. Stabilized participation improves structure. Structure supports trends. Another effect of this phase is risk recalibration. Risk feels different after confusion fades. Participants reassess exposure. They choose balance. Balance reduces emotional swings. Reduced swings improve consistency. Consistency attracts longer-term capital. Longer-term capital matters most. This phase also resets expectations. Overconfidence cools down. Cooling expectations reduces pressure. Pressure distorts judgment. With less pressure, decision-making improves. Markets begin respecting time again. Time replaces urgency. Urgency creates mistakes. Time creates alignment. Another result is improved patience across assets. Assets stop competing for attention. Competition creates volatility. Patience creates harmony. Harmony does not mean uniform movement. It means logical movement. Logical movement builds trust. Trust increases participation. January's early confusion filters weak conviction. Strong conviction survives. Survivors guide the next phase, not the noise. Another outcome is clearer leadership. Some sectors begin standing out. Leadership emerges quietly, not dramatically. Quiet leadership lasts longer. It avoids exhaustion. This phase also improves emotional discipline. Participants learn restraint. Restraint is a competitive advantage. Few practice it. Those who do perform better later. Markets also begin rewarding preparation, not reaction. Prepared participants feel less stress. Less stress improves execution. This is when positioning becomes meaningful. Meaningful positioning lasts. Another shift is reduced headline dependency. Behavior takes precedence. Behavior is harder to fake. It reflects intent. Intent drives outcomes. Outcomes follow discipline. January's tone influences February behavior. Momentum carries forward, but only if structure is respected. Structure cannot be skipped. Skipping structure leads to reversals. Reversals punish impatience. Those who understand this phase feel calm. Calm improves focus. Focus improves timing. Timing improves results. At MarketPulseUSA by AB, we focus on recognizing these quiet shifts, so you don't misread early signals and you don't rush decisions, because January is not about speed. It is about alignment. Alignment builds confidence. Confidence sustains performance. As this phase completes, the market becomes more honest. Honesty reveals opportunity, but only to those watching. Confusing markets demand clarity of mindset, not constant action. The first thing to accept is uncertainty. Uncertainty is part of the process. Trying to eliminate it creates stress. Stress leads to poor decisions. Instead of forcing trades, focus on understanding behavior. Watch how markets react to news. Reaction matters more than headlines. Notice what holds steady. Stability reveals confidence. Avoid chasing early moves. Early moves often lack confirmation. Confirmation requires time. Time cannot be rushed. Use this phase to reduce emotional exposure. Less emotion improves judgment. Keep position sizes manageable. Manageable size reduces pressure. Pressure clouds thinking. Clear thinking improves timing. Observe multiple markets together. No market moves alone. Dollar, stocks, and commodities interact. Interaction reveals structure. If signals disagree, do not force alignment. Let markets resolve disagreement naturally. Resolution brings clarity. Another important step is expectation management. January is not about fast results. It is about setting foundations. Foundations support growth. Use this time to review discipline. Discipline matters more than strategy. Strong strategies fail without discipline. Discipline survives bad periods. Avoid information overload. Too many opinions confuse focus. Choose a few reliable signals. Ignore the rest. Consistency beats intensity. Always. Be comfortable with doing less. Less action often means better action. January rewards patience quietly, not loudly. Those who respect this phase enter later with confidence. Those who ignore it chase later with regret. Markets will eventually reveal direction. They always do. But direction only helps those prepared. Preparation happens now. This is not a passive phase. It is a learning phase. Learning sharpens awareness. Awareness improves execution. Execution determines results, not prediction. At MarketPulseUSA by AB, this is exactly why we focus on calm understanding. So you don't feel lost during uncertainty, and you don't react emotionally. This channel exists to bring clarity, not excitement. If this series helped you slow down your thinking, then it served its purpose. If it helped you avoid rushing decisions, then it added value. Make sure you're subscribed to MarketPulseUSA by AB for daily US market clarity. Like the video if it helped. Share it with someone who needs patience right now, and drop your questions in the comments. We read them. In the next video, we'll look at how markets usually behave once this confusing phase ends. That transition is where opportunity appears, but only for those prepared. Stay patient, stay disciplined, and stay aligned with the market.